Good afternoon, everybody. Welcome to your Thursday edition of the TraderMerlin show. As Skilled Stocksman says out there, Wagwan. Yeah, that's like a hello, what's up in Jamaican. Yes, did survive. I haven't shaved or cleaned up at all, but got in late last night, luckily right before the airport closed. So good trip, good time to spend with family. We did survive the hurricane season. It really wasn't that bad. A couple thunderstorms, some thunder and lightning, which made it all the more enjoyable. But now back to the real world, trading, investing, and hopefully growing our wealth through different investments. So today's topic is going to be exclusively driven by questions that came in over the last week. There's been a lot of timely things. Of course, people have been asking me about the ARM IPO, and I kind of made a graphic just summarizing kind of four main questions I'm going to get into today. Number one being in the upper left, the automaker strike. You've got the ARM semiconductor, which really isn't a semiconductor company, really just a technology firm doing their IPO today. We'll talk about that. You also have the antitrust lawsuit from the Justice Department against Google, and of course, Cathy Wood making some purchases of Roblox. So that will be our focus du jour. I am glad to be back. It's funny, I actually was thinking of broadcasting from the pool side. As most of you know, I was at an all-inclusive for the last week. People keep asking me, what'd you do? What were the highlights? I literally sat by the pool and swam in the ocean just about every single day and just relaxed, met some new people, from all over the world. It was all-inclusive, so ate a lot of food and drank a lot, which, fine. You're stuck on a resort. What are you going to do? So, yeah, I'm glad I'm back, but it's nice to do those types of vacations to recharge. But it was really, I want to say, very uneventful. I didn't do anything crazy. Some snorkeling, a little bit on a boat, but other than that, it was pretty mellow. And next vacation, we'll have a lot more sightseeing and tours and stops to discuss. So let me run through. I'm going to do the Q&A first, and I'll go through the 7 markets. Just so you know, before I forget, I did get stopped out of my S&P today. Took a loss on that S&P. I bought puts directly. I still have my puts open for IWM, and I also sold some puts on IWM as well as SLV. So I'm still sitting on those, but just want to let you guys know because I remember we talked about that before I left on vacation, how I wanted to close that out, and the S&P has just been ripping. So looking pretty darn good there. So let me start with the Q&A. We'll start with question number 1, which was about the automakers. Actually, let me get my buttons right. There you go. And that was from Alicia. Says, how do you see the auto strike impacting automakers? Now, this is very similar, at least a little bit, to what we saw with UPS. Now, of course, it's probably in the best interest of these automakers to resolve whatever issues they have. However, I'm not an expert in these areas. I was in a union many years ago. I have to say, I absolutely disliked the union that I was in. I found that it was an excuse for lazy people to just be lazy and hide under the union umbrella, and those who are really hardworking and ambitious, really no upside potential. So didn't enjoy it when I was in the union, but I know it does help keep things standardized. That said, from my understanding and just kind of knowing a little bit about the auto industry, I'm sure if Tom is here, he would correct me even more. OTA is having a session about central bank digital currencies. I'm surprised I didn't know about that, John. I am the resident expert on CBDCs. I don't know, maybe I'm supposed to be in that one, but I'll find out about that, John. I do have a lot of comments on CBDCs. We've discussed them a little bit here on the program. So with regards to automaking, when you look at where they are made, let's say we do go on a strike, right? I'm going to look at UPS's strike first. If UPS went on strike, all of a sudden packages don't get delivered to all of us, which means it directly impacts you, and it directly impacts businesses that are using those delivery vans to send packages around the world. So all of a sudden, distribution of goods and services comes to a grinding halt, and that is a massive domestic as well as global impact. If if auto workers go on strike, what happens is the cars won't get produced. And I don't think that's really going to put a huge bind on me personally. I think many of you would probably go, well, not going to impact me that much. The people that it will impact dramatically will be the people in those Midwest towns, predominantly where you see these car manufacturers are is Midwest. I've made a list of some of the ones I could think of. You got Kansas City, Missouri for Ford. You got Dearborn, Michigan for Ford. You've got Montgomery, Alabama. You got Smyrna, Tennessee. You've got Georgetown, Kentucky. A lot in that Midwest area. Those towns could be severely impacted. Now, I think the number was something like 360,000 auto workers potentially going on strike. That's going to happen, in theory, at midnight tonight, if I'm not mistaken. I think it's midnight tonight if they don't reach an agreement. I don't really see the impact being that massive as far as economic impact for the U.S. I think it could have a dramatic impact on those local communities and businesses out there if all of a sudden, those workers do go on strike and realize they may be in it for a while. Whether it's 10 days or 100 days, that could have a big impact on it. So, Alicia, I'm not really looking at any kind of play there. When you look out there and, you look at something like Toyota Motors, clearly not a lot of fear about a strike going on for Toyota Motors. When you look at General Motors, GM, has been kind of dead for a long time. The spread trade deluxe here, for those of you, anybody here is a spread trader, just kind of stuck near the lows. Let's see what else we got. Ford. Let's go look at Ford. I don't really see this being that big of an impact at this point. It feels like they're kind of just floundering anyway. But my guess is we will probably see a strike. It might start for a day or two. I think that they'll come to some agreement. I read something that the union workers are demanding 40 hours pay for 32 hours worth of work. And I thought, what? That doesn't make a lot of sense, does it? So we'll see if that one goes through. But personally, I don't think, Alicia, that this is going to have a huge impact on the U.S. I think, again, it's going to be very regional. I would, if you want to make plays, you find businesses that are out or are centrally located in those cities. And I think that could have a big impact. Elon Musk would probably love an auto worker strike. Probably. At what point does Tesla go unionized? At some point, it probably will. But right now, no. He's probably loving that one. So that was your first impact piece. This came in yesterday, obviously. It says, can you talk about the ARM IPO tomorrow? Well, John, I wasn't there to get your message and talk about it yesterday. But all in all, this is one of the big hype IPOs. Now, I am not, everybody here knows, I will tell you, never touch an IPO, right? Always stay away from an IPO. And here's the reason. When an IPO comes to market, they're doing every single thing that they can do to hype that as much as humanly possible because the underwriter gets paid on that strike price, right? They want it to be as high as possible. Now, the range for the IPO price, just so you know, was between $45 and $51. So that's kind of where they expected it to open. And I believe it was actually lower than that before, but with all the hype that they've been hyping and pumping this thing up with media and all that and AI, perfect timing, it's slowly moved up. So the range was 45 to 51. Let's go look and see actually what happened with ARM. And lo and behold, there's your monstrous green candle. Notice it didn't even open at 51. That was the high end of the range. If I put this on a 5-minute time frame so we can see the whole day worth of trading, its actual opening price, the first trade that ever happened on ARM, was open at $56.21, and it subsequently has been ripping from that point. So we're seeing, a nice move up in ARM, and that, of course, is driven off of speculation and expectation. Now, they do have some financials. You can start to see their numbers, but this is this is hype. This is why I don't like IPOs, because typically for the first 30 days, you should stay away from them until you can get some shorting potential. And then typically there's a better shorting opportunity coming in the next month or two on this bad boy. In the after hours session, you're up another couple percentage points. But let me look at another one that it's in a completely different industry, and that'd be Snowflake. And you guys might remember when Snowflake came out, I was like, don't touch it. The thing, I thought it'd be underneath $100 by a certain time. I can't remember what the time frame was, but I was wrong. Here is what happened with Snowflake. And there you go. So you can see it's IPO day, right? It IPO'd right here. So Snowflake IPO'd at an opening price of $245. It shot up intraday to a high of $319 and then fell apart, right? You saw it just drop down way below its IPO price at $209. Now it did rally back up. You saw it break that 400 mark and subsequently now has just been dropped to a low of, what was that low price? About 184. And Now we are at 162. So I guess my moral of the story here is I wouldn't get caught up in all the hype of all this. I would simply wait. If it does have a huge surge and you can short this one, I would do that. But again, shorting IPOs is very, very risky. The general liquidity is not there. There are shorting rules, which means you cannot short some of these for a specific period of time. Maybe options will come into play at some point. But that's Snowflake. With the ARM IPO, I wouldn't mess with it. Now, for those who don't know what ARM does, they basically make CPUs and chip designs for companies like Apple and Google and different semiconductor companies. They kind of sell the technology and create the chip structures for these companies. And a lot of AI companies, I believe, will be using ARM to build out their AI chips going forward. Kind of like the advantage that NVIDIA has right now. I keep getting Snowflake now, I'm messed up. ARM has that potential. So I think obviously great technology, great idea. I don't know enough about that business to say whether it's going to thrive or not. Personally, I don't touch it. I don't trust IPOs. I don't believe that the valuations are ever what they say they're supposed to be. Remember, all the analysts, all the fundamental people looked at this company's numbers and said it's worth 45 to 51 bucks a share, and then all of a sudden it's not even trading at that, it's trading at 60 plus. So, you're telling me that this thing already has a valuation that's 50% higher than what it should be? That is pure speculation. It's funny, somebody asked me about the Skittles ban. I don't know if you guys saw this one. I guess the state of California is trying to ban several bad ingredients that are banned in other parts of the world, but California trying to protect our people, I guess. We're talking about banning red dye number 2 or red dye number 7, one of these dyes. And I guess Skittles uses a lot of that. So now there's this big story that they're going after Skittles. Well, they're not going after Skittles, but I don't know. I don't have a say in that matter. Maybe Marshawn Lynch will be upset because he was the big Skittles guy. All right, we've got through the first 2 stories that I was going to talk about, which was the automakers, ARM, and then the third one is an interesting one, and I think that this is something we should certainly pay attention to. Mark says, I'm long Google and nervous about the court case. What can you tell me about it? Should I be worried? Anytime the Justice Department is involved in litigation against a company, you should be worried. I mean, you can't just shrug it off like, oh, no big deal. Now, if I'm not mistaken, I believe Google already has another lawsuit from the Justice Department. So they got multiple lawsuits going on with the Justice Department. Now, if you look at the price of Google, look, people aren't that worried. Here's the price chart. This is not like it's brand new. These issues were brought to light back in 2020, and you're just now starting to get the court case going. So what I would expect for anyone who holds Google is a lot of volatility. Now, I read an article a while back talking about this court case and saying that if it does, go in favor of the Justice Department and go against Google, then you could see the markets totally collapse and massive downside movement. Yeah, certainly that's on the spectrum of possibilities, right? And I think that's the way we have to look at our trades and investments in anything we do. Heck, even going swimming in Jamaica where we encountered some jellyfish, you always have to calculate the full spectrum of possibilities. So with Google, on one hand, let's say they get out scot-free. There's absolutely no case by the Justice Department. It gets dismissed, and Google just goes about its business as usual. Okay, great. Stock price will probably have a nice pop to the upside and continue to trend up. On the other complete opposite spectrum, Google now gets but broken up by the Justice Department. They have all kinds of regulations with regard to their search engines. And mind you that this specific court case, just so you know, is antitrust. It's saying that they're doing things that prevent innovation and competition with regards to their search engine browsing. And they're paying billions of dollars to Apple every year to make them the premier. When you type in search engine, Google pops up. Well, that's just advertising. I don't see an issue with that personally, but I'm not a judge. So, should you be worried? I would expect there to be a lot of volatility, Mark. Personally, what I would do is I would just put a trailing stop on this or put a level on it where you say, if it gets down below it, I'm going to get out. Now, the risk with the Justice Department litigation like this is these moves, could be massive. So if there's a settlement where Google says, hey, we're going to settle with the Justice Department and we're going to pay a $20 billion fine, you could see Google drop 10, 15% overnight. And there's really no way to predict when or how that's going to happen. The fact that they've been embroiled in this lawsuit and are going to court, just started today actually, is not news to anybody. And you notice, look at the price chart of Google. this is all knowing that Google is going to court. So I really don't think it's that big of a deal. I personally don't own any Google. I would be a little skeptical about opening trades on it, but I don't think that this is going to be a major mover for Google to the downside. Now, keep in mind, this is also something that's probably going to go on for years. Now, I really don't see this court case getting resolved in 6 months or a year. I think this will take multiple years for them to resolve this one and tons of legal fees. But yeah, I don't think you should necessarily be worried about that one, Mark. So there you go. Let's see. Lisa says, welcome back. I saw that I believe to be insider big trade Netflix. There was a whale trade on Tuesday indicating big bearish move. Was there a big whale trade? So typically what I like to do is, you say a whale move there, Lisa. Okay, and then you followed up with, then yesterday CEO made an announcement and the stock dropped hard. Insider trading could very well be. So let me go break this up into a 5-minute time frame and add on volume. Because if it's a huge trade, yeah, I would argue that there's a big potential for that to be insider trading. Here's how you can tell that this is insider trading to me. And good eye, Lisa. I think you've nailed it. And unfortunately, I think our regulators are way too stupid to figure this stuff out. I don't get it. I mean, this is real basic. What I'm going to do is I'm going to scroll back here a couple weeks, just a regular day, right? For those of you who might not be new, who will be new to these charts, I'm going to take out the after-hour session, the after-hour, these colored bands, right? So we'll do regular trading hours. Notice that, it starts off usually with high volume, drops to midday, gets lower, and then it surges near the end, right? I'm going to put a line around the high spikes of volume, just so we get an idea of what might be high, right? And I think right about there, you guys can see that's a fairly high strike or high price or high surge for volume. Oh, that's going to do on a price, unfortunately. Let me see if I can get this volume in a second window. Dial visibility. I don't pay for the visions or the version, so I don't think I can get it into the second window on this one. We'll fast forward here and show you what the volume was like today. So you guys can see, obviously, there's massive volume yesterday with announcements that were made. Was the announcement today? So you saw the big surge here. I'm looking at this one right here. I'm looking at the one right before market close. There was a massive volume, one of the biggest spikes of volume we've had right at the last minute. And of course, the CEO making an announcement, that's suspect, right? When I see a huge drop in price and you get big surges in volume like that, yes, I would say that's insider trading. But it's hard to prove, right? The SEC and regulators are going to have to go back and find who made those trades and when. I don't know the exact timings of these and when these announcements were made, but yes, that could very easily be an insider or someone with a lot of shares because, you have the volume here was 60,000 shares of stock traded in a 5-minute window. And then back here on just at close of business tonight, you had another pretty big block of 96,000 traded. So yes, insider trading, in my opinion. Anytime you see a big move like that before the announcement, it may not be the CEO. He'd be stupid to do that. Let's be honest. All right, the CEO would be dumb to make that announcement. But when you have these earnings announcements or major economic announcements or financial announcements for a company, you all know as well as I do, if you've ever worked for a company, a financial statement for the quarter for a business doesn't just, okay, hit the button, it's ready now. It's been done days, if not weeks before. They've vetted it, they've gone over those numbers, and whoever has eyes on that has access to insider information, and they could easily leak that to somebody else. So typically, someone's not going to be dumb enough to sell a huge block like this and move the market because you're just going to draw attention to yourself, but certainly could have been insider trading on that one, Lisa. And my final one, before we get to overall markets, I need to wrap it up early today because I do have a meeting at 3 o'clock. Back in the saddle working again. This one was an interesting one today from Carrie. Carrie said, you see Cathy Wood bought a bunch of RBLX. I did. Yes, I absolutely saw that. And let's go look at RBLX real quick. So we'll make this a daily time frame just so we can kind of see how it all panned out. You look at this one. First off, I'm not very bullish on RBLX or Roblox. So this isn't really a Metaverse game, although the graphic that I did use in the video or in the AI picture I created for you guys today, I did make it kind of a Metaverse. But it's kind of an interesting idea. I don't know if you guys have played with it, but Roblox is a subscription-based service where you can play a whole bunch of different video games and different programs, but you kind of have a little subscription card and you get to play them all. Nice idea, just not really my cup of tea. I know friends who have kids that like to play on these ones. I look at this price chart. What did Cathy Wood see here that makes her believe that this is going to turn around, right? It's been flat since April of last year. So you're over a year and a half of just sideways. We'll throw the Tom Barr box on here. This is the one thing I hate about taking time off is people just stop watching the show that are generally regulars. So hopefully we'll get Tom back at some point. But there is your yellow box for this one. I can remove volume. It doesn't look good. I mean, it's just been traversing sideways. Now, granted, she may have loaded the boat down here at $27, and you notice that the range is double that. So this is a huge range on Roblox. Personally, I'm not a fan of buying that one. Is Cathy still a market mover? Yes. You know why? Because she's in the headlines. Anytime that the media is going to pick up a story on whatever you say, whether it's Warren Buffett or Bill Ackman, Charlie Munger, you name the famous person. When a famous person gets out there on CNBC or Fox or Bloomberg or gets quoted somewhere as saying, hey, we're doing this, you have masses reading those stories. You have masses reading those articles, and that is what moves it. So yes, I still say she's a market mover. She still is this tech queen a lot of people view her as. So the fact that she's jumping on this one makes me wonder what she's looking at, why she saw it. Again, these fund managers have way more information than you and I have or will ever have. They're meeting with the people at Roblox. They know the financials. They know the fundamentals. How they might even be getting kickbacks from the executives at Roblox to make these statements that they're buying shares of Roblox, right? Because there's this insiders at Roblox want the share price to go up. All in all, I just don't see a reason why I'd want to be a long-term holder here, Carrie. I'm interested in long-term gaming. I'm interested in games and Metaverse, but I just don't see the money flowing in there like the billions of dollars or trillions of dollars people were expecting. If evidence of that would be Facebook, right? Mark Zuckerberg put a lot of money into getting Facebook positioned to be the leader in Metaverse. They've dumped it. They've dropped Metaverse, and now they're focusing on the AI side because that's a lot more money and much more impactful. So while I think it's fun to drop into the Metaverse every now and again and play some games, I don't know. I just don't see the addiction to it. It's not for me. I'd rather go out in the real world and do things. But Cathy Wood's bought it. Take it for what it's worth. Cathy Wood's had a pretty rough time with her ARK fund. Oops. Here's her ARK fund. And you guys might remember back here, I think this is when Colin Teddards was on the program where we did a show talking about how the future was looking pretty rough for Cathy Woods, and that was when this thing was back at $100 and it fell all the way down into the teens. Now it's back at $43. So have to get buyers in order to sell. Exactly, August. Absolutely. You have to convince somebody out there to buy them. Yeah, anytime I read those headlines, guys, I always think the opposite. So the fact that Cathy Wood says she bought all this makes me think she's selling. Just the conspiracy theorist in me always thinks the opposite of it. All right, let's go and look at our top 7. And then I'll run you through a couple things that I'm doing. Here's your 10-year. Really surprised day today, honestly. The dollar index kind of threw me off. We had a dollar was surging and the markets were surging. It was a really bizarre move for our markets today. Anyway, here is the 10-year, which was the worst performer, only 0.14% today. Well, actually, if it rolled in the new session, so that's not exactly true. That's in the new session. So it actually was up today. Let me get you the exact percentage. This one rolls over way earlier, so the numbers are always wrong when I quote them. So let me give you this one. And as far as move, it was 0.66% day gain. So all in all, looking pretty good. The week I missed hasn't done much. But notice it's been sitting at this 4.335 mark. We talked about it getting back up there. Now it's just hesitating. I think you're going to break it. This pattern, this trajectory of the bond or the 10-year bonds yield really looks like it's going to be a breakout and a bigger move to the upside. Now, what does that mean for you and me? That means I've got to put this out to a weekly time frame, look off to the left, and try to find where this is going to go to next. All right, so I'm going to zoom in right here, which will be the next big obstacles. And let's move this line from 382 to the next area, which will be right around 470. 4.7, and then I'll do one more as we get up here near the top, which will be somewhere right around, nope, I don't like that one, somewhere right around 5.25. Right, those are your next two big milestones as far as where the yield's going to go. But right now it looks good. It looks real good because it's been making higher highs, higher lows. It had its pullback, not as deep as I wanted it to go, but now challenging those highs that we saw from back in July. So all in all, this is bearish for the markets. If this keeps going, put more pressure on the equity markets. Now, just to add to that, of course, coming up next week, we have the FOMC meeting. And for those who may not know, that's a big one. Now, I was expecting, given the CPI number that came out yesterday and the PPI number that came out today, which we'll look at here in just a second, I was actually expecting there to be maybe a little bit of an uptick in the possibility of a 25 basis point increase tomorrow. Not going to happen. Here are the results, not the results, the forecast. You can see right now 97% chance we're going to get a pause at the next meeting on rates, and a 3% chance that they're going to increase by 25 basis points. And that has been declining for the last month, right? It's been dropping slowly. So really no one's pricing in a 25 basis point increase. But, I gotta furrow an eyebrow here, because look what you had yesterday. You had your year-over-year CPI tick up for the second month in a row, right? We were a bit lower. Now we've ticked up a little bit higher. That's not a good sign. If we look at that's the year-over-year. If I look at what came out today, which is your PPI, notice that's the fourth month in a row we've seen significant increases in producer price index numbers. So again, that's most likely to pass on to consumer down the road. That's more inflation. And the Fed has talked about how they want to aggressively stomp out inflation. So boy, it would be interesting to see a surprise rate increase by 25 basis points. But let me show you the calendar here for next week, and we'll just go out and show you that chart so you guys can see what it looks like. Here's the Fed funds rate. Right now, expectations are we're going to stay at 5.5%. And you can see that aggressive increase for the past year and a half. We leveled out back in May and in June, raised 25 basis points in July. Now the expectations are we're going to pause again, but boy, seeing inflation tick back up has got to make everybody wonder if the Fed's going to be more aggressive here, just because they've made it very clear that they'd rather be more aggressive and stomp out inflation. Now, you did see a surprise, by the way, for the main refinance rate for the European Union. They also were going to stay the same, yet they came out at 25 basis points higher than expected. And that, to me, I know it's a long shot, and sometimes I like the long shots, but the long shot for me, based off the CPI and PPI numbers, are that we'll get a 25 basis point increase at the next meeting, which would be a little bit of a shocker to the market. What did Margaret ask? Do you believe that supply and demand can predict interest rates by using a chart such as that one? No. When you say chart such as that one, I'm assuming you're referencing the main refinance rate one. Which chart was that, Margaret? I've been switching back and forth, and there's a delay here. So let me know on which chart. I think maybe you're talking about the CPI and PPI numbers. I think it can. Like, if we start to see these numbers surge like this, I think that means that that demand is going to drop. The higher the CPI number gets, the more demand declines. The yield chart. Okay, let me go back to that one. Thank you. So, if we look at the 10-year yield, remember, this is the cost of goods, the cost of money. The higher this goes, the more expensive money gets. So, if the cost of money gets higher and higher and higher, in principle, it will impact demand, right? Because if money costs more, then demand is going to slow down at some point. And yes, I think you can. I don't think it's a clear, easy predictor, and there's no real definitive thing that says, it's going to happen in this time frame. I look at this as these are brakes being put on the economy. And back here in 2020, there were no brakes, man. It was just full on pedal to metal and pour gasoline straight in the carburetors, man. It was just launch that thing. Well, that stimulus has slowed down, and now all of a sudden, inflation is the issue, and this will rise until inflation gets under control. So this is essentially the brakes being put on the market. If that continues to go up, those brakes are going to impact demand, meaning we will buy less and less and less because the economy will slow down, people will get unemployed, will lose their jobs, they have less money to spend, and that becomes the demand-supply motivator, if you will. I hope that makes sense. Money get more expensive without Fed actually raising rates then? Yes. So remember, the 10-year here is not the Fed. 10-year is the Treasury. So if you look at what the Treasury Department does, the Treasury Department sells bonds, notes, bills, different maturities in order to raise money to fund government operations and mainly really to pay off the interest on the debt that we owe. We borrow money with bonds. when the Treasury sells you a bond, they're borrowing money. So let's say they sold you a bond at 4%. Now they got to pay that 4%, but they don't have any money because it's one of the most poorly run businesses in the world is the U.S. government. So what do? They sell more bonds. But now people realize that the economy is struggling, that the government might be faulty. So they're no longer going to sell it to you at 4%. They'll sell it to you and they're going to have to pay a higher yield. They have to pay more because people don't want to buy this stuff. And the government now has to sell more and more and more. So the more 10 years or more bonds the government sells, the higher that rate's going to be, assuming demand stays the same. If more people look out there and say, hey, I want to buy U.S. government bonds because, hey, it's paying 4.3% right now for a 10-year, if there's a ton of buyers, then the government can actually drop its yield. But they're having to issue more and more and more bonds just to pay the debt that we owe. Bill Addis, his focus class, I would highly encourage you guys to check that one out if you're at Online Trading Academy. Great class. I've had him on the program many times. Try to bring him on once a month. He was mentioning that they had 2 auctions back to back, which they don't do. I think he said he'd never seen that happen. And they were record numbers, meaning they just were trying to sell as much as possible. They're flooding the market, means yields are going to go up. And that's what we see on this chart here. Supply of the 10-year has been growing, and therefore the yields are starting to surge more and more. In different times, demand different rates. Usually, yes, yep. 2-year cheaper than 5-year, usually, correct. So, there's a really great resource that I like to look at. Let me bring it up for you guys. I'll copy it in the chat if you want. 1 second. Let me go faster if I type and don't talk. Usually when I type and talk, I make all kinds of mistakes. So there's a thing called an animated yield curve or a dynamic yield curve, which for anybody who's interested in learning this stuff, I highly recommend you copy this link that I'm going to throw in the chat here in just a minute, just to help you learn how this all works. So here you go. So there's a link that should work. And let me know if that doesn't work, and I'll send you another one. But basically what it is we have, look at the left-hand side of my screen, right? You can see it has the different maturities. You have 3-month, 2-year, 5-year, 7, 10, 20, and 30-year. These are different maturities of government bonds. And right now, you notice that the short end of this, the 3-month, is paying over 5%. And the 30-year is trading in about, well, let's call it, it looks like about 4.4%. So I could buy a bond expiring in 3 months, right, or Treasury, expiring in 3 months and get 5% yield or more, actually more than 5%. Or I can invest my money for 30 years and only get 4.4%. But that's out of line. It should not be like that. And let me scroll back here just so you guys can see when it's a normal market. So let's go back into here. This is what a normal yield curve looks like. Now, it shouldn't be pegged to 0 as this red line shows you over here, but this is going back into August of 2012. Right? It's August of 2012. It was pegged at 0. Let's go before the financial crisis. This is a normal yield curve. This is back in 2005. Here's 2000. Let's go 2003. Right? Short end. You usually don't get paid a lot of interest for buying short-term bonds, right? You're not committing your money. There's really less risk, so you don't get paid much. This is a normal yield curve. The longer you invest for, as Talking Monkey says, the longer you invest for, you should be getting paid more. You should earn more yield because you're committing and taking that longer-term risk. This is a normal yield curve. It shows you the bottom right here. Now let's go to where it started to invert. So if you go to 2007, right before we really started to fall apart in the U.S. markets, we had a flat yield curve, which was almost all the maturities at the same level. All right, almost all those maturities are sitting right around the same level. That's flat. That's not a good thing. And then you get the dreaded inverted yield curve, which we have today. Let me see if I can. Oh, that's 2018. It's actually not even letting me get to the one we have today. There you go. This is as of today. This is really ugly. It means you can get paid a lot more for short-term versus long-term, and that's broken. And historically, this is one of the most reliable measures of market recessions. This is the longest extended period of time where the 3-month has been higher than the 10-year, and significantly higher. Now, I'll show you some other charts here, which, again, we drew these out a while back. But what I'm looking at here is this is the difference between the 10-year and the 1-year. So normally, if you buy let's say you buy a 1-year bond and you get, let's say, 4%, you should be getting 5 or 6% on the 10-year. That's not the case. Right now, you're earning 1.14% more for just holding the 1-year, not the 10-year. Most financial sites will quote the 10 and the 2, and that's got a difference of almost 0.75%. Now, I know it doesn't seem like a lot, but 0.75% when you're trading with, you're buying a couple $1 million worth of bonds can make a massive difference. So right now, demand for that short end of the yield curve is surging, right? Why lock up my money for 10, 20, or 30 years when I can get a better rate of return over the next 3 months? Now, the only reason that you would be buying the real long-term stuff right now is if you thought that going forward, the long-term rates were going to stay right around 4.4%, and that short end was going to crash back down to, let's say, 0. That's the only reason you'd buy long-term right now. Like, I wouldn't buy. Let me ask you this. How much time do I got? All right, I have to wrap this up. Let me ask you this, and type it in the chat what you guys think. Under what reasons would you buy, let's say, a 10-year bond right now? Like, give me a reason why you would say, I don't want to buy that 3-month and get over 5%. I want to buy that 10-year and get 4.3% right now. Why would you do that? I'll leave a couple seconds here before I give you my main reason on why you'd want to do that. So for those that get near to retirement and get older, you're supposed to shift your portfolio into bonds because generating income streams becomes very important and you want to keep a stable store of value. For me personally, the only reason that I would buy a 10-year right now is if I was, let's say, 65 years old. Right? I'm 65 years old and I want to make sure I have a certain amount of income and I got $1 million. Got $1 million coming in. So what I would do is I'd take my $1 million. Let me type it in over here. Take my $1 million. And I know that bond's going to pay me 4.3% per year. So we'll times 0.043. Oops. Where did that go? Times 0.043. I'll earn $43,000 a year in interest. Pretty much guaranteed. Now, the thing is, I don't care what happens with the yields going forward. If yields drop, even better for me. If yields surge, I don't really care because I've done the work and $43,000 or that amount of money, whatever it is what I need for me to live off of. Great. It's a way for me to lock in a committed rate of return for my money. That's really the only reason for me personally that I would do it. Let's see, what else we got? Margaret says a world economic crash. Potentially, but then you have to put your faith in the full faith of the U.S. government. Talking Monkey says sideways market for 10 years. I would argue that you're better off if you have a sideways market, spread trade and just get way better rates of return than that. Market's safety. Yeah, and when they say that this is the risk-free rate, remember, nothing is risk-free. The longer that I'm alive, the more the discussion is the U.S. is going to default on its debt. Our debt to GDP ratio is surging. We keep on taking more and more debt. It's gone parabolic over the last 3 years. So, the discussion will probably become much louder in the circles of economics with regards to defaulting on the U.S. debt. And remember, if they default on the debt, bonds may get hit as well. Les says, I run a fund that must own 10-year bonds. That's a good point. I mean, if you're a bond fund and you have to buy bonds, sure. Okay, well, Les, you win that one. You got that one. That is what is crushing many U.S. banks. They locked into bonds when rates were lower. Yep. And they're borrowing. They've borrowed long-term to pay short-term because they used to be able to borrow long-term. You borrow money at 10%, or sorry, a 10-year at, let's say, 5%, but you pay your customers 2%. Well, it's 3% spread for you, free money. But since that became inverted, now they're taking these, 3% bonds they bought, actually probably more like 2% bonds, but now they're having to pay 5% to their customers. They're upside down underwater. That's the main reason these banks are going under. Uncertainty in general, Moneyball angle. Correct. I agree. Rate arbitrage. Yeah, you could do that as well. But for me, it's about locking in and committing knowing that I need to get a certain amount of income per month or per year. That's one of the main reasons I would buy government bonds. But that's pretty much it. All right. I got to run. I have a meeting I got to go to. So let me just wrap this thing up. So we covered our 4 main topics for today. Let me bring that up here, my wonderful AI graphic. Thank you for Midjourney for creating this one. We did the auto worker strike, which I think is going to be not that big of a deal unless you live in, Detroit or some area that's really reliant on autos manufacturing. You have the ARM IPO we talked about. Be careful with that one. I'd say stay away from it personally. I'm hoping that it just continues to rally for probably another 30 days, and then we'll see if I can get some options, and I'll buy some long-term puts on that one because it'll probably come crashing back down due to all the hype. You have the regulation side of things, looking at Google and their antitrust with the Justice Department. Only thing I can say there is I expect volatility. I really don't think it's something you should be that freaked out about. It could go on for many, many years. And finally, you got Cathy Wood buying a big chunk of Roblox today. Chart looks like garbage. I'm not a fan of Roblox anyway, so I would probably say just stay away from it just because. Earnings-wise, you had Adobe report earnings today. They beat earnings, but were down on the day, and that's pretty much it. Home builder Lennar also had earnings, and they beat and were down as well. And then finally, let's look at your economic calendar for mañana. So there's the September, there you go, Friday the 15th. For the U.S., you've got Empire State manufacturing numbers coming out. That's going to happen 1 hour before markets open. You also have import prices. You've got industrial production, capacity utilization rate, and then the insignificant number, preliminary University of Michigan consumer sentiment and inflation expectations. I don't put emphasis on those anymore. I used to, but I really don't think they're that big of a deal. Now, you do have the ECOFIN meetings and Eurogroup meetings, which will put Lagarde as the president of the ECB. She will be speaking. That's going to be in the wee hours of the morning, but that will be before our market opens. And again, there's a lot of things that she could say that could really have an impact on the market. So, for example, any comments with regards to inflation, helping out the economy over there, right? Stimulating their economy a little bit more. Cryptocurrency is a big topic as well. I might talk a little bit tomorrow about some of the interesting things going on in the digital asset cryptocurrency space, but she is one to watch out for because an absolute market mover. Michael says, what does Roblox trade under? RBLX is the ticker symbol for Roblox. Yeah, it's not Roadblocks. It's a weird one. It's ROB, let me bring it up here, RBLX. It's ROBLOX is the name of the company, but the ticker symbol is RBLX. And it's really just been sideways for a long time. I actually, when I was doing my research for my crypto course, I basically jumped into all the Metaverse games, every single one of them that I could, and was just playing around with them and didn't find any that I thought were absolutely gangbusters. But maybe I'm just not a gamer. John says, buy an annuity. Under certain circumstances, I think an annuity may be good, right? But you really have to do your homework there. Do not, I repeat, do not go to an insurance company and buy an annuity without doing your homework. They will sell you on an insurance product or an annuity product that's going to be very high fees and most likely not the best one for you. So do a lot of research, dig into annuities before you ever even approach the insurance. Because remember, they're salespeople. They want to sell you this stuff, and usually the insurance salesman gets a big commission check for one product versus another. So I think annuities can be good, but you have to understand your personal situation and how it all works. Next guest on this show? Oh, I don't know. I've had a couple people ask me to be on this show. I'm always hesitant bringing on people I don't know because I don't want people to sit here and use this as a platform to try to sell you on stuff. But I guess, in order to expand this, I should be doing more of that. So I don't know. I don't have any set guests right now, but I'll see if I can get some on for you in the next week or two. Since you guys like the guests, you're probably tired of me talking all the time. All right, well, that's my welcome back show. We did your economic calendar, did your earnings calendar as well. I had these two here. So right now, I'm still, let's go back to the daily. So I still have a big put position on IWM, even though today hurt. The last couple of days have not been that great. But I saw that put position. SPY got stopped out today. XLE got stopped out today as well. That one, actually, I got stopped out a couple of days ago, but that one I didn't have a big position in. But it's just been going and going and going. Pretty crazy how the XLE rallying. But of course, when you look at the chart of crude oil, gee, I wonder why energy keeps rallying. I thought we'd see a rollover. We had the right. It did for a couple of days and then just rallied and stopped me out. So I'll stop that on those two. And then the big surprise has been silver. Silver is right down that 2050 line, which is where I'm very happy to own it. I may actually see what happens on tomorrow's session. I may sell some more puts tomorrow, so I get that week decay and just do them for the week. But I'm okay owning silver long term, even if it drops further from here. But 2050 looks like it's been an area that's held. But remember, the more times you hit a level, the more likely it's going to break over time. What do you think about retail stores like? Yes, but I made a much smaller position. And I still have a little bit of UNG. Not a lot. Just, I do still have some UNG. Right now, I have calls against it that expire. I don't know, I think I have an $8 strike on it that expires tomorrow. And we'll see. I'm not really liking what's been going on with this price chart, especially UNG and Boyle, and those have been really, really ugly. UAA, Under Armour. What do I think about retail stores? I mean, look, again, Michael, you know, you've heard me say this many times. Look at the chart. The chart tells me this thing's dead. It's like if I gave you a tennis ball and the tennis ball had a lot of bounce to it, you're going to keep playing with it, right? What's this tennis ball doing? It bounces as out of it. You know, maybe you use $7 as your backstop for Under Armour. Not a big fan of it. You know, I don't know. I don't use Under Armour myself. I'm not a big fan of name brand products anyway. I just buy what I like. But the chart does not look good. I'd stay away from it. And then Macy's, I would run away from Macy's. I think that not only are these retailers, these high-end retailers like Macy's, going to start to get hurt even more, but what's going on with the mall theft, especially in different states around the U.S., San Francisco, Chicago, I think there's been some really big raids on stores like Macy's. And I think that they're going to start to shut down and pull out of different markets, and that's going to hurt them overall. So, yeah, I'm not a fan. You know, if there's an old phrase that I love, it's one of my personal favorites, says, the trend is your friend until the bend at the end. And you look at this trend of Macy's here, it looks down. You look at the trend of Under Armour, the trend is down, and now it's sideways, but still down on that big picture. So I would stay away from both of those titles. What are my thoughts on cannabis? It's had a huge, unbelievable run, but I still, until we get the federal approval, I just don't want to put any money in. I had some in there for a while and lost money on a cannabis company that my friend was actually working for. He's like, buy it. This is why you never listen to your friends that work for a company. He's like, we're going to do great. We're going to make so much money. I'm like, really? Okay. I bought into this cannabis company. They did nothing but go down. Yeah, great. Thanks for me. Good job for me. But Mike, you know, right now, I don't know. I think what you're going to get near the end of Biden's term will be a real heavy push to legalize. He needs something under his belt to gain the support of the populace. And I think maybe I'm wrong, but it seems to me that the majority of Americans, you don't have to be like, hey, I think people should be walking on the street with a joint. But I think you're probably in this school of thought that it's just a plant. It's not like you're getting walking zombies from people that smoke weed. You're getting people use it as relaxation, cure some medical stuff, glaucoma, anxiety, depression. You know, there are some medicinal benefits there. And I think more people are starting to realize that it's not Reefer Madness movie where all of a sudden you're running around chasing people with an axe, chopping them up. It was such a great hype movie. But until it goes federal, I just still think you're going to see struggles. You're going to see consolidation going on. You know, knowing some growers personally who have gone through the trials and tribulations of it, they were making great money. Then all of a sudden, it's going to become legal and everybody's growing it. Now you're just flooding the market with supply. Eventually, some of the suppliers are going to disappear, and I think that's what you're witnessing right now, is that consolidation phase of so many people that were growing and bought all this equipment are just failing, and they'll just get consolidated into somebody else, and then you will get more economies of scale, right? You'll have some big name that comes in and starts to become this monster powerhouse, having bought up all these failed companies, and then they'll control more of the marketplace, and then you'll start to see prices stabilize and more profit margins come in. But the days of, $4,000 a pound cannabis, gone, right? Businesses can't make it. Now you're down to, let's say, getting close to $1,000 a pound. And I think what will happen is, ultimately, that these manufacturers, these cultivators, right, these farms, will get it down to $700 a pound, $500 a pound because of economies of scale, and then the profit margins will start to step in. Once you squished all the competition, you are the competition, and now you can kind of raise your prices. So I think that's going to happen. What's my smartest way to use margin? Damn it, I gotta go. I guess I would say my smartest way to use margin is really about if I'm in a winning trade and I've got something running and I want to add into that trade, I'll go into margin, right? I don't start trades off going all margin. I just don't like to do that. If it's something that's going in my favor and I've got a nice runner, I'll look to margin and add to that position, but I got to make sure that I keep moving my stop loss up. It's that snowball effect that once things start to roll, you don't know how far it's going to go, but you want your position size to be getting bigger and bigger and bigger. And that's where that margin comes in. But you've got to make sure that you have your stop losses accordingly, because the bigger you get, It just takes a smaller move to wipe out all those profits. So that's kind of how I view it. I think it's all about scaling in and making sure that you don't go all in with margin, and you never use margin. This is probably more important than when to use it, is not when to not use it. You never, ever use margin on a losing trade. Ever. You're in a losing trade, just get out of it. That's your thing. That's why you gotta have that stop loss in place. All right, guys, I gotta wrap up. Tomorrow it's just gonna be a typical Friday whiskey show. I've got about 6 more questions to get to, but I wanted to cover these topics because they're timely, they're big, they might be market movers for us, and hopefully you guys enjoyed that. And those who did send in those questions, that was Alicia, John, Mark, and Carrie. Thank you for the questions. The rest of you, send them on in to TraderMerlin@gmail.com or put them down below any of the YouTube videos. I will get to all those questions on my Friday show. Thank you. Good to be back, and I will see you guys tomorrow. Take care.